Now, what is the role of corporate governance? Now, it's vital that we understand what corporate governance actually is. So, the Cadbury Committee, which in the UK was maybe the first time corporate governance was properly considered, describes corporate governance as the way in which organisations are directed and controlled. And as I've said there, basically the way companies are actually run. And we have two methodologies that we could apply to corporate governance. Firstly, we have the principle-based approach, which is very broad, and therefore companies need to be able to adopt the spirit of the code of corporate governance against certain practices. There is this sense of comply or explain approach, which basically means the code requires companies to comply with what the code says, but it's not mandatory. But what is preferred is if companies do not comply with the code, they explain why. And if that explanation is good enough, then that's fine. So comply or explain why you don't comply. So the UK Corporate Governance Code is heavily principles based, okay? Basically taking the spirit of the code and applying that to a scenario. The code, therefore, is relatively small because it's a broad set of principles. Another way could be a rules-based approach, which basically, very big document setting a very specific set of rules. Now, of course, no rule book can cover every single eventuality, and therefore it's likely that those rules have got to be adopted but also updated on a very regular basis. And if it's a rule, they have got to be abided by, so not a comply or explain approach. And a typical rule-based set of principles is from the US, and that comes from the Sarbanes-Oxley Act. So as a recap on what corporate governance is, well, we start from the top, the tone of the top, okay? We need to ensure, if we have corporate governance, that the board at the top of the organisation is effective, that they engage with the shareholders on a regular basis, and the board is there only for the business to maintain long-term success. There's also the need to divide responsibilities, realising that no one person can have total control because the role itself is too big for it to be done properly by one person. We need to ensure that the board is being led by an independent chair, and there should be no one group within the board that dominates. We need to have non-executive directors, the voices of shareholders who are there to hold management to account, to ultimately challenge management on their decisions. In order to be a member of the board, whether an executive director or a non-executive director, there should be appropriate and rigorous appointment procedures, ultimately for the business. And note, it's absolutely vital that diversity is promoted. And this should be looked at on an annual basis. From an audit perspective, but also business risk and internal control as well, corporate governance needs to ensure that both internal and external are as independent and as effective as possible. And therefore, they are there to ultimately produce a risk management process in order for internal controls to mitigate. Corporate governance also looks at the remuneration of directors, which should be aligned to why the company is there, what its values actually are. Again, corporate governance is there to promote the directors' work only for the company, and therefore the directors are there to promote the long-term success of that company, and remuneration should be there to basically attract, to retain, but also to motivate the individuals in that position. What shouldn't happen, directors should not be involved in setting their own pay, and therefore there needs to be independent oversight on the appropriateness of remuneration. Now, how does that help the external audit process? I've said audit risk may be lower, and the reason I say that is because if we have good corporate governance within an organisation, within an entity that is being audited, then that in itself provides a very, very good feeling that this organisation is being run effectively, that the directors are running the organisation for the organisation and not for themselves directly. And therefore, there is a strong control environment. We have good internal controls which are designed effectively and they operate effectively in order to mitigate any risks. This ultimately reduces the risk of material misstatements instead of financial statements, and therefore reduces the audit risk, because having a good corporate governance is in itself a good control, which is designed effectively, and hopefully, if it's a good corporate governance regime within an organisation, it is actually operating effectively as well. Now, there are some additional fee-generating opportunities. There may be the requirement for the auditor to report on whether the organisation does comply with the relevant corporate governance code for that organisation. That is an additional non-audit service. One of the roles of corporate governance is the need, or at least consideration of the need, to have an audit committee. And the audit committee, made up of non-executive directors, independent non-executive directors, should also be there to measure the effectiveness of the external auditors, that they are complying with ethical standards, for example, independence. The fees are set by the audit committee. Now, corporate governance within an organisation, how should this comprise? Well, we have independent, non-executive directors, there to challenge management, one of whom should have recent financial experience to be able to understand the information that is being put in front of them, and to be able to challenge the management, the directors, on that financial or on that set of financial statements before sign-off and publication. One has recent financial experience. This will help the board with its responsibilities, but it's important to note that that individual who has the recent financial experience, they are not the only person who is responsible for this. The board is equally responsible, but obviously helped by that individual with recent financial experience. The need for independence is vital. So non-executive directors are the voice of the shareholder, and they are there to challenge the executive board of directors, and they are there to ensure the controls are being monitored. But what non-executive directors should not be doing, they should not be performing the functions themselves. Otherwise, by definition, they would not be independent. There has to be a certain degree of space away from the operational nature of this business. Now, an audit committee, part of corporate governance, is there to review internal controls. Now, they may not do that work themselves, but they are likely perhaps to have an internal audit function. and the internal audit function are there to monitor, not design, but monitor those internal controls. And the internal auditors should be reporting to the audit committee, and therefore the audit committee should be deciding upon the work plan for these internal auditors. Once this work has been done, the results of that internal audit work need to be looked at. Not just looked at, they need to be acted upon. If the results, for example, a weakness is identified and they are not acted upon, then that does suggest that the role of internal audit is perhaps just lip service and cannot be relied upon. The financial statements, before they are released, before they are signed off, they would be reviewed by the audit committee. Are they appropriate? And that's why we need this individual with financial experience to help other members of the audit committee to really understand and to ask the questions that ultimately are required to understand whether these financial statements are appropriate. What sort of accounting policies exist? Are they appropriate? So an accounting policy to depreciate land, is that appropriate? Possibly not. To depreciate a building? Probably yes. Are they appropriate to this business? And therefore it's important for the non-executive directors to have experience of that business. And I recall from previous slide that the audit committee is there to review and manage the relationship with the external auditor, including the setting of the fee.